Hello, everybody. My name is Greg Hart of PSMJ, and welcome to Change Ahead 2022 AEC Compensation Practices Checkup. Now more than ever, compensation is a hot mission-critical topic for AEC firms. There's always that struggle, but now it's more pronounced than ever of balancing compensation demands and the desire to, of course, find and retain the best team, while also preserving profitability and making sure the company's on a sustainable financial track. It's a big issue, and we're hearing about it from all corners of the industry. So we've got a great discussion today with an expert, one of our consultants who has a whole bunch of great insight on this issue of compensation practices. But before we get started, I do have a few quick housekeeping notes. First, if you registered for today's broadcast, you'll receive an email within about 24 hours with a link to the recording of the broadcast, as well as other important information. So keep an eye out. You'll have an email coming from me with that information. And that email will also include, if you're attending the live broadcast today, you are eligible to earn one AIA learning unit. And that follow-up email will include a link to access your certificate. If you have any questions on any of that stuff, if you don't get the email, you have a question about your certificate, customer service at psmj.com. Customer service, all one word, at psmj.com. If you have any questions as we go through the broadcast today, and I'm sure you will, enter those in the Q&A panel at the bottom of the screen. We have a big group with us today, and I suspect we'll get a lot of questions. We'll get to as many of those as we can at the end of the broadcast. If we don't get to your question, we'll try to follow up with you after the broadcast. But if you have a question as we're going along, enter those right into that little Q&A panel at the bottom of your screen. Our speaker today is PSMJ Senior Consultant Jared Jamison. If you don't know Jared, after a successful 20-plus year executive career in AEC operations, financial management, and business strategy, Jared shifted gears to pursue his passion for helping other firms succeed, and he joined us here at PSMJ. He spent most of his career as a senior vice president and director of operations at full-service 200-person AE firm Hankins & Anderson, where he was responsible for developing and implementing the firm's strategic management system and improving their quality management. After that firm was acquired by Mason & Hanger, Jared integrated the two firms' operations and was responsible for developing and monitoring the firm's strategic plan. He's also served as department head, chief structural engineer, and senior structural engineer. He knows his stuff, and he's one of us. He's been in the industry for a long time. With that, Jared, I'd like to welcome you on here to kind of get us started. I don't want to take up too much of your time because I know you got a whole mountain of content that you want to cover. So if you could, Jared, you can jump back on the screen here. There we go. Jared, welcome. I've hyped you up as the absolute whiz here, so I'm sure you're gonna give us a lot of great insight. Jared, it's all yours.
I appreciate it, Greg. Thanks for the introduction. I'm going to go ahead and dive in here because, as Greg said, I have a whole lot I want to cover today. I want to make sure you get your money's worth. And so, as he said, today we're talking about compensation practices and sort of checking up on them for this year. And I sort of changed the title around a little bit as I was looking this over. And I say it's the growth and uncertainty continues, because I think we're experiencing a whole lot of both of those right now, and the two are playing off one another. And we're going to talk about that. So the first thing I want to do is start off with this. I want to scare you a little bit. This is an article out of the Wall Street Journal. It was either last week or the week before this kind of popped up. I read all the ones about compensation and inflation that we have. And this one that said big raises are coming in 2022. So make your game
Jared,
plan now.
I'm just going to interrupt you 1 sec.
Yes.
I'm not seeing your screen share. You might just need to pop that up.
Thanks, Greg. See, I got all excited and got ahead of myself.
You know what, Jared? It's such an exciting topic that it's easy to get carried away. There we go. And then flip over to perfect. There we go. Thanks, Jared.
Cool. Thanks, Greg.
No problem.
Appreciate it. So this was the headline, right? The big raises are coming in 2022. So make your game plan now. And so that's kind of what we're talking about today, right? Except that this article is not targeted towards us as business owners and people running businesses. If you read the little headline below that, says, do your research, focus on your contributions, and be willing to walk away. This was ammo for all of our employees, right? How to talk about this because the market's hot for this right now. So I'll go ahead and just tee that up for you to scare you a little bit to get your attention. So here's what we're going to try to cover today. Like as I said, so there's a bunch I want to go over. I want to talk about the industry and sort of what's going on now, and the growth that we're seeing, what's happening with turnover, and how that could potentially be increasing. We'll talk about this generational shift we've talked about for a long time that we're actually seeing happen now. Of course, no presentation now would be complete without mentioning COVID-19 and its impact on our business and work from home. We're going to talk a little bit about compensation equity. This is a topic that's getting a lot more focus now. It's very important, and it's something that's going to affect our compensation. And all this sort of leads to wage pressures. We'll talk a little bit about that and the financial implications and how it is that you can plan for what's happening right now. And I'm going to close this off. I'm going to talk a little bit about our compensation survey. It's kicked off now. This is survey season at PSMJ, and talk about some really cool tools that you can get for free for participating in these surveys to really help you set your compensation. So Greg already introduced me. I won't spend a lot of time here. Other than sort of my background is from the operations side of the business, helping run the business from that side. So that's sort of how I approach this compensation issue. I don't have really a human resources background because I had an awesome HR director that I worked with for a big part of my career. And I also love teaching. So I love doing webinars like this. Sorry if I get super excited. I used to teach back in Richmond, Virginia, as an adjunct professor of business planning at VCU. And since then, I've moved to way northwest Montana. So there's not a university here. So webinars and things like this is where I get to get my teaching out. So sorry if I get super excited about this. Well, let's dive in because we have a lot to talk about. Let's first talk about industry and compensation trends and what's going on here. And I'm going to share some data with you because if you've been to a PSMJ webinar or conference or something before, there's a lot of data and we love data. So I'm going to try to share a lot of this with you. So if you haven't noticed, the AE sector employment is pretty hot, right? It's now above where we were pre-COVID levels. So if you look back here at the end of 2020, we have a drop off here. So this is all employees in the AE industry. So, we're floating up around 1.6 million. Now you'll see the Great Recession. We took a hit back here between 2008 and 2010, and it's slowly been climbing its way out. Back in 2018, we reached where we were pre-Great Recession levels, and it continued to climb. We saw a brief drop off when COVID started, and then it came roaring back up to stay along that same trajectory that it was. So it only took us about 6 months or so to get back, or 6 months to a year to get back above where we were pre-COVID, and it's continued to climb. So now there's more employment now in our industry than there was pre-COVID. So every major market has been improving last year too, the outlook for these markets. This is from the quarterly market forecast we do. This one's hot off the presses, came out within the last couple of weeks. So you can see the red dots are where AE industry executives were, what they were seeing proposal activity do, whether, if it's above zero, it's growing, if it's below zero, shrinking. And the red dots are what's happening at the end of 2020. And the green dots are what's happening at the end of 2021. And you can see every market segment that we track it has a brighter outlook from proposal activity now than it did 1 year ago. And some of these made really big jumps coming out of that real uncertain time in COVID, such as education, commercial developers, and commercial users. So it looks really good. The outlook for the industry looks really good. But we don't really, if we ask executives from AE firms, hey, what's growth going to look like? We've seen a sort of a steady decline over the last several years. So when we asked this question a year ago, people saw lower growth than they had in the prior years, only at about 5%. So the market's super hot, yet we see, there's not a lot of confidence that we're going to grow a lot in the industry. So I'm curious, this is, put some answers here in the chat box. We have some opinions on that. why is it that AE principals are predicting sort of a slowdown in the rate of growth, despite the fact that all of these markets, the workload coming out of them, we see improving? Yeah, they're starting to come in, and it's the exact same thing. You guys know we cannot find enough good people. When we do strategic planning engagements at PSMJ, we typically start it off and by looking at 70 strategic issues that face AE firms and sort of sort them in a manner that we can really concentrate and focus our time together on that. And this is the number one reason that we've had for the previous 20 firms, but it's been like this for the last several years, other than a brief dip right when COVID hit, when the workforce was shrinking a bit. This one moved a little bit down the list, maybe it's still in the top 10, but this has been the number one reason. We cannot find enough good people to do the work. So yeah, this chart really tells the story. There's a severe labor shortage out there. If you guys have been trying to hire, which I know a lot of you have, it's tough, right? There's a lot of job openings for the number of people out there. So this is some data from the Bureau of Labor Statistics. And the latest numbers that came out for this came out over the last couple of weeks, is through November of 2021. And you can see that this is the number of job openings in business and professional services industries. The BLS data for this particular item doesn't get granular enough down to just the AE industry. So we have to zoom out a little bit more to the business and professional services, of which AE is a good chunk of this. And we'll see the number of job openings, if we look all the way back to the year 2000, is at historic highs. There's in the total of 1.8-ish million openings across this industry. Now, if we look at this as a percentage of the total number of employees within this industry, it's about 8%. So that means, in this large industry group from the BLS data, for every 100 people working, there are 8 openings now. So there's a lot of competition for people out there right now, and it's tough. It's a tough labor market if you're doing the hiring. So let's look at turnover. AE turnover may have started increasing a couple years ago. We track this data as part of our financial performance survey, which is also kicking off soon. We've got a lot of data that goes way back. I'm really glad that I was still in college back here in the early 90s and late 80s timeframe, because the turnover was pretty high back then from what we've been used to over the past 10 plus years. And hovering around 18-20%. We saw a gradual decline in that turnover rate, and sort of into the mid-teens. And then you can see the trend line here. It starts to slowly increase, and I think that has to do with we had a big drop off here, had high turnover in the Great Recession. You come out of it, people are uncertain, then you start to get certainty back in the economy, and the economy starts to pick back up, and that turnover starts to sort of increase again. So it's something that we need to keep an eye on. Notice the scale here, 9% is the bottom of the scale. So we're still 10% plus on average for turnover. So this is always a big challenge for businesses, but it could be getting to be more of a challenge. So overall, large firms have been doing a pretty good job over the last couple of years of reducing their turnover. So in this chart, you can see the red bars are the percent turnover in 2021, the blue in 2020, and the gray in 2019. And the groupings here at the bottom are firm size, based on the data that we did, or the data we collected as part of our 2021 bonus and benefits plan survey. And you can see here that the larger companies, anything from 50 up, were able to decrease their turnover between 2020 and 2021. So they did a pretty good job. You get to the 20 to 50, and they saw a slight increase in turnover between 2020 and 2021. These are from the 2021 survey. So this is 2019 and 2020. And then in 2020, these smaller firms in 1 to 20 saw a lot of turnover. They saw their turnover really increase. They had been lower in 2019, and in 2020, this number really dropped up, or this number really increased up. And I think we think this has a lot to do with the fact that perhaps they didn't have quite the war chest to weather the storm that we saw on the horizon when COVID started to kick off. And a group of these folks went over here to these folks. So large firms have been doing a good job. Smaller firms really have to keep an eye on this now. So there's all this talk. I wish I'd come up with this phrase, because it really is catchy. The Great Resignation. I'm sure you've heard about this and read about this. What does this mean for our industry? Like, is this happening? So again, this is data from BLS, and this is for that same group we talked about before, business and professional services. And what they track here are quit rates. So this is essentially voluntary turnover, the percentage of the workforce that is quitting every year. This last data point is right here, tied with the high that we had earlier this year. So in November of 2021, this was up at 3.7%. And if we look back all the way to the year 2000, this is at sort of near-term historic highs. This number is way up there. I went looking for this data after I read an article in the Wall Street Journal several weeks ago that had talked about this, the Great Resignation and the quit rates going up. And they mentioned several industries. They mentioned the hospitality industry, the retail industry, and the business and professional services. So that really got my attention, and I thought, hey, I got to go dig for data. And here it was. Yeah, it's been increasing in our industry. So this is something we really want to keep an eye on. You can see it was really low coming out of that initial wave of COVID. Probably a lot of uncertainty. People were scared to leave. And it's been steadily increasing since we came out of that sort of low after 2020, as the economy picks back up and people get a little bit more certainty. So perhaps some pent up demand here, but it's something we definitely need to keep our eyes on. So we surveyed this and said, well, what are the reasons that staff are leaving? And you can see, far and away is the third bar over. That's the biggest one. And it's for personal reasons. And this, you read, this is in our industry. And when you read about the whole idea of the Great Resignation, this comes up a lot as the reason why people leave, right? They had all this time to sort of reflect on their lives and what they want to do with it. And this personal piece comes into it, and they decide, I'm going to make a change. And here you can see that number up there, why people leave. So again, something that we really need to keep our eye on. So there's other factors at work too that are increasing turnover. And this is one of the big ones. The retirement wave is well underway. Ever since I started in this industry, there's been all kinds of talk about this, right? We have all these baby boomers, they're all going to retire, and it's really going to hurt the workforce. We'll have a brain drain, all this other sort of stuff. And we're starting to see that. Here's some forecasts for what percentage of the population will be over 65. And you can see it continues to climb. And by 2050, it's almost 24% that they're projecting. And even now, this number's up close to 20% of the population over 65. And if we look at, okay, that's great, but what if they continue to work? That's a possibility. However, if we look at what's happening with retirements, particularly because of COVID and sort of the influences of this, we see that we've seen a jump here between 2019 and 2020. You see this big jump of the percentage of increases and baby boomers retiring. And it's a pretty big jump. So here you can see the headline: the number of retired baby boomers rose more from 2019 to 2020 than in prior years. So we're seeing this. We've got people that are leaving for personal reasons, and then we have people that are retiring, and this number of retiring will just continue to go up, right? And so we're fighting a lot of demand and not as big of a workforce. So I'm going to use this. I'm going to use this opportunity to collect some data here, because I love data, and I know PSMJ loves data, and never turn down a good chance to get it. And so I'm going to ask a question here, and we're going to put a poll up on the screen. If you want to go ahead and fill it up, Greg. There's what's happening to voluntary turnover at your firm in the past 6 months. Has it A, increased, B, decreased, or C, stayed about the same?
All right, Jared, yeah, we'll just give that a second here to stabilize, and still coming in, but it looks like it's gotten pretty stable. So we'll go ahead and share the results. Hey there, can you see it on your screen, Jared?
Yeah, I can see it.
There you go.
So I'll tell you guys, just in case you can't, have increased. We have 41% of the respondents say that voluntary turnover is increasing. Only 10% said it was decreasing, and about half are say that it's staying the same. So we have more increase than decrease, but about half said that it's staying the same. I think I just hit share results. I don't know if you guys see that, but thanks. That's good data. We asked this question back in October of 100 firms and said, what's happening to voluntary turnover for you? And it's funny, we got about the exact same answers that we just saw. About half or a little bit more said it stayed the same. And the majority of the other half said that they're seeing it increasing. Typically in the past, when we've asked this, we've kind of seen a 1/3, 1/3, 1/3. Perhaps this stayed the same. There's some uncertainty that are keeping people around, maybe building up some pent-up demand, but we see this increase has increased. So we are seeing some increased turnover, and it's something we really need to pay attention to. All right, so I'm going to shift gears a little bit here and talk about another factor that's really affecting compensation, or if it's not yet for you, it could in the very near future, and that's compensation equity. So what I mean here is, are we paying our employees equitably when it comes to things like gender, race, religion, origin, and things like that? I think everyone inherently wants to do this. It's the fair thing. It's the right thing to do. But sometimes there's, I'm sure you've all heard of the term unconscious bias. Somehow, sometimes that creeps in over time. And what it can do is create a problem for your firm, right? So it's something you really need to be paying attention to. And we're seeing a lot more attention be paid to this recently. So I'm going to talk a little bit about how it is you can look at this and what it means for your firm. So other than this reason that, hey, it's the right thing to do, or it's the fair thing to do, there are other reasons you really want to address pay equity with your staff. They read about it and they hear about it all the time, right? It's all over the news. It has been for years. There's studies, particularly, there's studies just for our industry, across the economy. And what that does is create this general skepticism about pay equity, right? Between leadership and staff. Leadership want to do the right thing. Typically, they think they're doing the right thing, but there's skepticism from the staff's point of, hey, are they, or are they somehow benefiting from this? Of course, we're in a very tight labor market, like I talked about, and we are seeing some increasing turnover. And this could be a reason. Like you don't want to give someone an excuse, particularly a bad one, that shouldn't be there to leave. If employees don't feel that they're being compensated fairly, there's a big hit to engagement, right? They're not giving that extra effort. If they feel that they're not being paid fairly, and it just comes down to that people want to feel valued. This is one of the big intrinsic motivators, are that people feel valued and recognized, and compensation is one of the ways to do that. So it's an issue you really want to make sure that you address. So large firms, they've sort of got a head start on this, and this is the percentage of firms that have a diversity or equity and inclusion program or an initiative in place. If you look at the firms 250 and up, pretty much 100% of them do. That's something they've all been paying attention to for quite some time. Smaller number, or the smaller companies, it's sort of, as they get smaller, the number goes down. if they have a program like this in place. So it's something particularly these smaller firms really have to pay attention to, that they're paying their staff equitably. And this is from a survey we did at the end of 2021. So I'm going to share some more data with you here. If you're interested in this topic and you haven't read this study, this is a great one. It's the Equity in Architecture Survey that was done in 2018 by AIA, and they partnered with the San Francisco Art Institute. There's a hyperlink here, but there also, if you just Google Equity in Architecture Survey, you'll be able to find it pretty quickly. So here's some data from that. The data in this study really expands beyond this. There's a whole lot of it in there, but I'm just going to hit some highlights. So there does appear to be a gender pay gap among architects at every stage of their career. You can see production staff over here to the right, up to design principal on the left. And this greenish blue box are the males, and the orange are females. You can see early in the career that there's a small difference here, but then once people get later, and this, if they, as they progress up and get up to principal levels, there's a pretty big difference. This is nearly a $20,000 or close to 20% gap in pay. So yeah, there is a gap in pay here. So engineers have similar results, right? If we go and look at other data sources to say, hey, what does this mean for the rest of our industry? We can see this. This is BLS data as well from back in 2020. We can see all architecture and engineering occupations. There's an 18% gap between the men in blue and the women in gray. Civil engineers do a little bit better of a job. There's still a gap, but it's only 3%. Between the men and the women. Go civil. But all the rest of the engineers, we see it's back toward this big gap, much like we saw before on the architecture slide. There's a 20% gap in pay. This is perhaps a little bit more pronounced than it is for the architects, because typically you'll see the architecture, the profession there is a bit more diverse anyway for the group coming out of school. You have much more of a 50-50 mix of men and women than in engineering, which is still, unfortunately, leans more toward the men. So let's look at what happens over the course of someone's career. This is from the architecture survey. This is for architecture. You can see there's a small difference. These blue lines are the men in the data set, and the orange and red are the women in the data set. The red is for a bachelor's degree and the orange for a master's, and you can see that the dark blue is bachelor's and master's for men. So you can see there's not a huge difference in those degrees, particularly as you get out. But for the most part, they're relatively close for the first half of their career. But then as they progress in their career, once they get beyond about that 10-year mark, it grows much larger. This study, if you go and read it, for more, but you'll see that this could be, there's several reasons for this. Some of it could be tied to who's the primary caregiver for children, and what happens there. And is that fair? It's something, go and research this and look at this for what happens, but that may drive some of the unconscious bias that happens there. Now, it's important also to notice that there may be a racial pay gap as well. So here we can see in this chart, it's the difference between white males in blue and then black females in the orange. And you can see there's a pretty pronounced difference, again, once you get beyond that 10-year zone of your career. So how is it that you look at pay equity? How can you look at your staff and say, are we paying equitably, or do we have some unconscious bias? When we work with clients on this, there's several ways that we look at this. What we really try to do is go looking for questions by looking at data in several different ways. So here's some ways for you to consider looking at this, looking to see if to make sure that you're treating staff equitably. The first is looking at turnover by race and or gender. And so you're really looking at the percent leaving of these different groups and see if there's any patterns there. You can also graph compensation by gender and race to visually tell a story and look to see if you may have issues with your company. You can also do detailed pay audits and then also pay parity calculations. So what do I mean by pay parity calculations? There's a couple different ways you can look at this, and I'm going to cover a couple of them here to give you some ideas on how you can look at this at your firm. So here's the first. This is an example, some data from a company of graphing turnover by race and gender over the years. And this could potentially point to possible unconscious bias. This is possible. With all data, I like to always say data points to questions, not answers. So that's, we're here, this prompts a question and you want to go look, what's happening here? And why is this? Is this an issue we need to address? So you can see in this chart, this is each year you've got the percent women that are leaving in red and the percent men leaving in blue, and you have trend lines over that time with these dotted lines. And you can see for this firm, yeah, there's a significantly higher portion, particularly in the recent past, of the percentage of women leaving than the percentage of men. You want to look into this and say, why is this? And is something going on and what can we do about it? Now, I mentioned graphing salaries and how this can provide a good visual to really help point you to the possibility of unconscious bias in your pay systems at your firm. So this is a snapshot out of a tool that we use as we work with firms on modeling for this, modeling this for them. So it's out of our staff salary equity models. And here you can see we've graphed men's salaries over their years of experience. And with the salaries on the y-axis and years of experience on the x, we've graphed men over time. The maroon line here is the median for the industry based on the benchmarking data that we have, and the orange are women. And if we strike trend lines through that, we can see there is a trend of a gap here. And this is something that you would want to see what's going on and how you want to address it, and then go and address that. Another way you can do this, if you use position descriptions, is to go through for each position description and map this out. Say, how many men and how many women do we have in each one of these position descriptions, and what are the average salaries or mean salaries for each one of those groups, and then look for a difference. Is there a large difference between those for each one of your position descriptions? And that can sort of help you hone in on where you may have an issue. This is another screenshot of how we look at this when we work with clients, of doing a gender pay gap analysis with the survey data that PSMJ has collected over the years. And what we do for this is, instead of look at position descriptions, we'll look at groups of staff, so departments. In this example, it's the architectural staff. And we'll look at this based on their relevant years of experience. And I'll talk about that a little bit more here in a minute. We'll look at the relevant years of experience and compare them to the industry benchmarks for that relative year experience. So that's the first way we look at it. What's their current salary relative to the median benchmark of the data that we have for the years of experience? And we break that out and say, what is it for men and what is it for women? So you can see in this example, men are paid on average 102% of the median and women 99%. So yeah, that could be an issue. But we like to take it one step further and bring performance into the picture, because performance is very important as it comes to setting compensation. So what we'll do here is compare, based on their performance, we'll compare to different quartiles of the data that we collect for benchmarking. So if you're a below average performer, we compare you to the lower quartile, average to the median, and above average to the upper quartile of data. And we have this over under index that we've come up with at PSMJ to say, relative to that quartile, based on your performance, are you over the quartile or below the quartile? And you can add that up for men and women. And here in this example, you can see it's even more pronounced. Males are paid on average 7% above their relative quartile based on performance, and females 7% below. So even performance doesn't explain this difference in salaries, and it's something you would want to take a further look at. So let's talk about how you set compensation, because obviously this is very important. First, when we work with people on this, and as we've done this and collected data over the years, we've made some observations, and here's some common errors that people do. Now, the first one's going to sound like heresy to some people, right? Using position descriptions to set salaries. There's several reasons why that we don't think that's the preferred method to do this. Certainly, they're good at describing what responsibilities or expectations are, but they're pretty fuzzy. People operate above and below these position descriptions all the time. Another is using regional survey data to adjust for different locations. Locations are much more microeconomic areas as opposed to regions. There's a lot. You can look at towns that are very close to one another, and the economic realities of those two when it comes to wages are very different. So using regional salary survey data, we see that sort of as a mistake when you're setting your compensation. The other is to use consumer price index, CPI data, to adjust for different locations. CPI, I'm going to show you an example here in a little bit, can vary wildly compared to what actually happens with wages. Failing to adequately compensate for different performance levels, that's a big mistake. You want to pay your high performers high, right? You want to pay them more than the lower performers, or you risk losing them. And they're the ones you don't want to lose. The last is failing to consider the financial impacts of salary increases. You need to make sure this gets pulled into your budget, and that your budget's accounting for it so that your profitability doesn't suffer. So based on our research, for professional staff, these are the people working on projects most all the time that are not managers or principals. Their compensation is a function of 4 factors. That's the type of degree, the years of relevant experience, the office location, and their performance relative to peers. Now, if we look at management salaries, they're also a function of 4 factors, but they're a little bit different. Office location and performance still plays a lot into this, but instead of your degree, which is essentially whether you're an architect or a structural engineer, or mechanical engineer, your role in the firm plays the biggest part of what your salary is. And then firm size, instead of years of experience, firm size is much more correlated to salaries of managerial positions. So what we do with this data, and this is part, our compensation models do this, is that for each one of those positions, this is for the professional position. So you'll see we try to incorporate all those elements into one chart. So we have the degree, the position they have, civil engineer. Of course, there's salary on the y-axis. On the x-axis is the years of experience, and then we color code performance. And you can quickly see here by looking at this where you may have an issue. Here you've got someone that's below average performer that's being paid over the upper quartile of salary benchmarks for the industry. Here, down in the green, C8, you have someone that's an above average performer, yet they're paid in below the lower quartile of their peers in the industry. You risk losing C8 here. You want to adjust for that. So I mentioned that location makes a big difference, and often CPI is used, and that can be really misleading. Let's look at an example of 2 cities here. Boston, this CPI is 182% of the US average, pretty expensive place to live, whereas Atlanta is only 97% of US averages. However, if we look at what people are actually paid in the architecture engineering industry, we'll see that Boston's only paid 113 of the average in the US, and Atlanta 97%. So, there's a 15%, 20% difference between Atlanta and Boston when it comes to actual wages, but the inflation index is over 180% difference. So CPI is not really the way you want to look at adjusting salaries for location. Using the BLS wage index is how we suggest that you do this. So location brings up something really interesting in the times we're living in now, right? What is location? This is from a survey we did in 2021 to say what percentage of people do you expect to be working from home, or at least have the option post-COVID? And you can see pretty much across the board, every company size, 70% plus said that. Overall, almost 90% of companies we surveyed said some level of work from home will be an option post-COVID. Now, if you look at what percent of leadership. As you get some of this mid-range company, there's more that want to, but still, any survey, any group that we had less than 50% really prefer to have them in the office 100%. So this is a big shift. I think everyone knows this. It's been talked about a lot, but work from home is probably here to stay. Employees think they're super productive when working from home. When we surveyed this, 77% of employees said, I'm at least as productive or more productive when working from home. If you ask the project managers that, it's a little bit less. 61% said yes to that question. Still relatively good, about 50%, but not quite as good as employees see themselves. But we look at the data. That's not really what that shows. What happened and over the year 2021, when most people were working from home, we saw a drop in our direct labor multipliers that we actually achieved. So this is the amount of revenue that your company is getting for every dollar that you charge to a project. And it dropped from 3.3 to down close to 3.1. This is a really good measure of productivity. Utilization didn't drop nearly as much. So people were working on projects, but we weren't getting paid as much for it, which said maybe you're burning a little bit of time and not getting paid for it. So that would suggest a drop in productivity. So something to really keep your eye on, or keep your eye on. So because of this, we got to bring everybody back into the office, right? Not so fast, my friend. We surveyed on this and said, if you're allowed to work from home after this whole COVID crisis is over, would it increase the probability of staying with your firm? Over 50% of the people we surveyed said definitely yes. 32% said maybe. So only 15% said no. This work from home thing would not affect at all their decision to stay with the company. So you can see the title here. If your firm wants to hang on to employees, something you're really going to have to consider as we eventually pull out of this thing. So this brings up some really interesting questions as it comes to compensation, setting it, and the models. How do you pay an employee that's assigned to a high-cost office but decides to work from home in a lower-cost location? So here we can see an example in California, in San Francisco, where you have a wage index of 122%, and Modesto, right down the road, with a wage index of 90%. Someone's going to move out away from the city, from San Francisco out to Modesto. What do you pay them? So we asked this question of 43 AE firms here in the last year and said, did you adjust pay for employees that are moving more than moving more than 60 miles from your office? Only 16% said yes, that they did. 84% said no. These are new kinds of questions that we're having to struggle with as it comes to compensation. Now, what we sort of suggest is, how would that go? I'll ask you this question to ponder. How would it go if you said an employee moved from San Francisco to Modesto and you decreased their salary by 30%? That's probably driving a lot of this no. So let's talk a little bit about the financial impacts of salary increases and what this could potentially look like. I'm going to kick this off with a poll. You can pull this poll up, Greg, real quick, and say, in the past 6 months, have you made job offers to new hires at higher salaries than comparable existing staff? This is a big challenge, right? When you're going out and trying to do it. And the answer is yes, I have. And we've adjusted salaries of existing staff accordingly. Yes, but we've not adjusted our existing salaries. And no, we've not made job offers at higher salaries.
All right. Yeah, Jared, that poll is live. Just give it a second here to fill in some great comments, by the way, in the chat about pay equity and related issues. One particular comment that I really like is a general sentiment that, it's great to study this stuff and see the overarching kind of context of the industry, but what's more important now, maybe more than ever, is to actually do something about it.
Absolutely.
Take action. And that seems to be a place where the industry needs to move. All right. Polls closed. I think you can see the results, Jared, right?
I can. Yeah. So this has sort of come up a little bit when we asked this question last time. We see over 50% of you said yes. We've had to make offers to get new staff in the door. We've had to pay them more than our existing staff, and we're adjusting the salaries of existing staff to sort of catch it up. Of the remaining half, about half said, yeah, we've had to do it, but we haven't adjusted salaries. And the other 25% or 23% said we've not made offers at higher salaries. So you can see when we asked this question, we saw about a 1/3, 1/3, 1/3. And we've seen here, this red has grown almost to 50% in our short survey or sort of unscientific survey that we just did here, but it's something you absolutely need to consider because it's a tight labor market. So let's look at what salary increases people are projecting. We asked this just last month, and we surveyed 241 firms and said, what do you see for salary increases upcoming this year? And, you know, on average, overall, it was 4.5. If you look at the professional technical staff, the median numbers up here are around 5%, and the upper quartiles even creep up to around 6%. So gone are the days of the counting on the 3% a year raises, right, for your budget, something you really need to consider. So another polling question, based on what your firm is seeing on that last slide, what do you think? Is that number too low? That 4.5, 5% too high, or just about right?
All right, we got that poll live here. By the way, also too, while we're waiting, a lot of folks asking about the recording, the slides, that'll all be shared in an email to registered attendees within about 24 hours of today's broadcast. And looks like we're pretty stable here, Jared. So go ahead and end that and share the results. There you go.
Okay, cool. So we'll see the too low, too high. The too low is a little bit more than too high, but the most of them say it's about right. So that's interesting. I'll share a chart with you that probably tells that about that exact same story. And this is from BLS. I just pulled this data last week. And this is in our industry, industry, what the average hourly earnings are for all employees. You'll see that it's been on a continuous rise since 2018, but that number has sort of shot up in the past year. And if you look over the past year, the average hourly rate has gone up 5.1%. But clients are pushing back on pricing, right? This is something we like to use as part of our compensation online masterclass that we do. And this is from a vendor, or this is from a client that sent out to all their vendors that say, hey, we're requiring, thanks for sharing the financial burden. We're requiring all vendors to reduce their prices they charge for goods and services by 20%. Now that was back in June 2020, different times, but this sort of tells the sentiment, right? It's tough to raise prices and clients are really hesitant for it. Luckily, we're in a position now, you could probably say, okay, good. Good luck finding another consultant. This does go on. Like, you've got to get this number right, your compensation structure. If salaries are too high, you're not going to be competitive. If salaries are too low, you're not going to be competitive for talent. So you got to strike that balance just right. So I'm hoping that some of the things I've go over today will give you that toolbox to help you really get that number right. Now, how does this affect, like, once you change compensation, it's gonna affect your financials. And let's look at that. There's really, profitability is a function. There's a whole bunch of KPIs, a whole bunch of things that you can track out there. But when it really gets down to it, profitability can be explained by 3 main KPIs. That's labor utilization, direct labor multipliers, and non-labor overhead. So labor utilization, I think everyone's familiar with that. It's the amount of direct labor you charge to projects divided by the total amount of labor. Direct labor multipliers it's essentially the revenue that your firm creates. So it's net service revenue that you keep within the firm divided by the cost it took to create that revenue, or your direct labor that you charge to projects. I've got the non-labor overhead grayed out. I mean, we do a pretty good job of managing this over time. These are really the big levers that you pull in the short term to really impact your firm's profitability. You can either increase utilization or increase direct labor multipliers to increase your profitability. Or if your labor costs go up, same, you can either increase your utilization or increase your direct labor multipliers. Now we like to look at this, this KPI revenue factor, and this sort of boils it down. Now we got one to worry about, right? If you multiply your labor utilization times your direct labor multiplier, you get this factor called revenue factor. And essentially that's the revenue your company's creating divided by your total payroll costs, right? So if your total payroll costs are going up, if you want to keep the same revenue factor, you're going to have to increase the revenue you get for that total payroll, right? Revenue factor over time is really highly correlated with profitability. You can see this, your operating profit in red and your revenue factor in gray. If you can manage this revenue factor and keep your overhead, your non-labor overhead in line over time, which again, everyone does a pretty good job at, you can manage your profitability. And if you need to get revenue factor up, again, you can increase utilization or increase direct labor multiplier. And a lot of times, good luck on increasing your utilization, right? If we look at these KPIs with slightly different definitions, when it gets down to more of the labor pool, we can see utilization is basically just the percentage of time you charge to the jobs. But direct labor multipliers can be broken out to your billing rate divided by your hourly wage. So this is how you set billing rates, right? You take the hourly wage of your employees and you multiply it by your billing rate. If you can't squeeze any more out of utilization and your hourly wage is going up, billing rate's the other variable that you have here. So, we may need to think about increasing rates to account for this big increase that we see coming for your payroll. So I am going to ask a couple quick yes/no questions. If you've been in PSMJ seminars and things before, you've probably heard this. In the last year, has your firm raised its rates?
All right, got that poll open here. Jared will just give it a second, and it looks like it's pretty stable here. So we'll go ahead and close that and share the results. There you go.
All right, so about 80% have raised their rates. That's great. That means you're sort of accounting for what's going on here in the economy. And the economy is super strong, right? You probably have backlog and you're having to say no. It's the time for it. All right, now only answer this question if you're in that 80% that answered yes before. Do you regret that decision?
All right, so we've got that open now. If you answered yes to the previous question, do you regret the decision to raise your fees? And it looks like it's coming in pretty consistent to what we've seen recently here. So I'll go ahead and stop that and share the results for you, Jared.
Yeah, we see this a lot when we ask this question. 97% no, I don't regret this decision. Great decision. A couple said yes. I don't know what went on there, but overwhelmingly no, people do not regret that decision. So it's something you're probably going to have to consider to counteract this, what's happening with your wages. All right, I want to spend a couple quick minutes to talk about our survey. It's survey season here at PSMJ, and we've just kicked off our staff compensation and management compensation surveys. The deadline is February 25th. If you participate, you get some free benchmarking tools with that. And I'm going to show you those really quickly. You also get discounts on the complete survey reports that we have. So February 25th is the date. Here, you go to our website, you can find it, but here's the hyperlink, psmj.com, survey, participate. And the free benchmark tools you get if you participate in these, it really focuses on some big key performance indicators that you get to help you benchmark your salary to see if you're competitive externally. And there's 17 different peer groups that you can use to compare yourself, and it gives you some great plots. You can look at this over time. If the staff compensation tools, here's the list of all the positions, everything from architects to the engineering groups and scientists and BIM CAD positions and marketing proposal coordinators. And you get salary data for all that. If you do the participant version, you'll get total comp, you'll get free benchmarks for total compensation. If you want to upgrade the tool, then you can get some more things, like you can get the split between salary and bonus and salary increase information to be able to benchmark salary increases for that. If you do the management compensation tool in the free group, you'll get total compensation benchmarks for all these groups. You can see we lump project managers in with the groups of managers, but everything from chairman to department heads, controllers, CFOs, directors of business development and HR, all those. If you want to upgrade that, then it'll break out a lot more information. It'll get total comp, the bonus versus base salary information, compensation as a percentage of CEO compensation, staff increases, and more. So I'm going to show this to you real quick. I'll show you what these tools look like if you participate. First, here's the staff tool. It's pretty easy. When you participate in the survey, you can go and just copy and paste your data from the survey in here, base salary and bonus information, and you select your peer group, either based on company size, your region, or your primary client mix. And then what it'll do is give you benchmark data for the median, the upper and lower quartiles of data, and tell you where you stand for each one of these positions on total compensation. If you go here and put in the trends of the data for the past 5 years, then you get some great trending data over time, as well as where each position currently stands relative to the quartiles of data for the benchmarking data that we have. Similarly, for the management tool, you can see here, same position, same sort of input. You can paste this in from the salary when you participate in that. And we have a whole lot of positions here. You probably don't have every one of them, but it doesn't matter. You paste the ones that you do have in, select your peer group, and you can get benchmarking data for each one of those peer groups. So this is free. Of course, we have a lot more data when we actually issue the entire survey, and that'll be in the May timeframe. So here's the last slide. I just want to let you guys know this survey is confidential. If you if you participate in it, each firm's only assigned a number to make sure that it's confidential, and we only use this data to provide the results. We don't use it to hound you or anything like that. And you can also do this anonymously through your CPA. Just reach out here to Jill Stoodley at PSMJ. Here you can see your email, and she can talk you through that. There's a lot of benefits, including discounts on the full surveys, and everyone loves Amazon, so you can get an Amazon gift card. So again, the link's psmj.com, survey participate. All right, so I've got 2 minutes. I'll try to dive in. And I told you I was gonna try to pepper you with data here. Try to answer a couple questions.
Yeah, Jared, there's actually a good question that came in a little earlier when you were talking about pay equity and the 4 factors that you look at in evaluating compensation. A question that we get from time to time is, what's the impact of registration or licensure? Yeah. You mentioned type of degree. Is registration, licensure something you consider when looking at this?
Yeah, so here's what we find over time. If we go back to that, go back to that, there's another way you can sort of account for that, right? I'll put this back up on the screen. So if you have, if your type of degree would be like architecture degree or civil engineering. Well, let's use civil engineering. If you're a civil engineer with 25 years of experience, 30 years of experience, and you're not registered, your performance relative to peers is probably not the, it's probably not the above average or much above average sort of performance levels, right? So you can get that in performance. I would say if you're not registered, you can account for that in this. So what we see, we collect data on this. Once you get out to like these higher years of experience, we see a lot of parity sorts come together where 90% of the, of the people with that are the more seasoned professionals in this 20+ year experience are all registered. And if not, they're probably not the high performers, right? So that's how we typically account for that.
Great, thanks. Just a few, we're almost at the top of the hour. A couple of people asked when the surveys are available. April for the management compensation, May for the staff compensation. Yep. A lot of folks asked about a recording and the slides. Yes, in the follow-up email within 24 hours of today's broadcast. Jared, thank you so much. Lots and lots and lots of good stuff. And thank you, everybody. Lots of great comments in the chat and lots of anecdotal stories and evidence and experiences that really provide some great color commentary to the broadcast. So Jared, thank you. Everybody who joined us today, thank you as well. Have a great rest of your day. Take care.
Thanks, Greg.
Thank you.